Vectors being our trend, our momentum, trend momentum, trend direction, momentum, and strength. Okay. Everything we do is going to be in line with that. Okay. Now, ultimately, in order to have a really good experience, I think, trading the system, you have to understand these pillars, and you have to also understand wave structure, right? Wave structure. You have to understand how the market moves. Okay. And so this right here is, very, very, very basic, but still powerful. Markets move in what we call impulses, corrections, like this. Impulses and corrections. They go up, they come down, they go up, they come down, they go up, but come down. Now, when we're talking about it from a market structure standpoint, right, we're going to call these lows and we're going to call these highs, right? Highs and lows. Now, what's happening, right? Market's making higher highs and higher lows. So we have this higher low here, right? These are higher highs here, and higher highs here. Now, the thing is markets do this, and then they will change directions, and they will typically do what we call retrace, right? They'll do something like this, right? Just change directions. And they'll also do it in a similar format of highs and lows, where you're having lower lows and lower highs, right? And this is a repeatable scenario here that you begin to see over and over and over again, right? And this right here is a very basic, right? Very basic understanding of how Elliott waves occur, okay? Now, I'm not going to go heavy. You don't have to know heavy Elliott waves, but you do need to be able to see this, right? That markets move up, and we have 5 wave structures, right? 5 waves. And that's when they're trending. They can also move down in 5 waves, okay? But in this scenario, it's moving up 5 waves. Then it will move down in approximately 3 waves. Those 3 waves can look all types of different ways, but this is the overall. This is going to get you there the majority of the time. This is how this market is moving. So impulse waves move in 5, correction waves move in 3, right? Put that in the chat. Impulse waves move in 5, correction waves move in 3. Okay, this is important. Now, the cool thing about this is happening no matter if we're trending or we are we're retracing. And because of this, right, this pattern, you're going to at least see this, or you're going to see this, no matter if it's a trend. I want you guys to catch this. You're going to see this movement or this movement, no matter if it's a trend or a correction, no matter what. Now, if it's a trend, it's going to do this. If it's a correction, it's going to do this and go the other way after that. So what is the thing that we can see in both of these scenarios? Well, we're going to get this boom, boom, boom. Or we're going to get boom, boom, boom. And then again, like I said, if it's trending, it could go boom, boom, or boom, boom, or boom, boom. But I want you to focus in on that 1, 2, 3. 1, 2, 3. Okay. That 1, 2, 3, that is our best friend. Okay. That is our best friend. And it's important to understand that this is what makes ORS special. When I first started trading, right, everything was really about reversals. Okay, reversals. And, you know, essentially we understand when markets are moving, they're going to be going and they're going to hit a wall, and then eventually they'll hit that wall and they'll turn around. But the problem is there was a wall here and there was a wall there and there was a wall here. And eventually it was this wall that they turned around at. And what would happen is we'd take a loss here and a loss here and a loss here and finally get a win and call this a great strategy. Now, sometimes it could be a profitable strategy, but for me, it was oftentimes a frustrating strategy because this right here always felt like I was wasting my time for me personally, right? For me, I felt like why are we doing all of this? It's like, this felt very much like a guess and check method. Guess and check. That's how this felt. It felt like a guess and check. And sometimes trading is a little bit of that, but this just made it, it's like we're going to go down just to try to come up. Like we're going to take 3 losses just to try to get 1 win and cover up those losses. And hopefully it's enough to cover it or just bring us back to break even. And that was my journey, right? If I could go down the list and show you guys strategy after strategy, and they all had the same premise, that we're trying to catch these reversals. Markets are overextended. Now we're going to try to trade them back. The markets are out of balance. We're going to try to trade them back into the place where the imbalance began. We're going to do, and everything was this guess and check method, right? I don't want to throw any strategies under the bus. I'm not going to throw any names out there, but if you've been in the space, there's so many strategies that are like this. Okay. So many approaches. And it wasn't for me after a while. Okay. And so there was a key strategy, and I'll show you, that had us paying attention to overextensions. And the reason I'll show this to you is because it's a part of how I got here. And you'll be able to see.
I'm going to reveal the only 5 to 7 stocks that I believe you should trade options on. Hi, my name is Mike Shore.
Do you ever wonder why some traders are consistently profitable and others aren't using trend lines? The difference between the two is how each one uses the trend lines or utilizes the trend lines. Hi traders, welcome to my channel. I am Tori Trades, and I
might not give it to me. I'm gonna have to make it real quick because
I'm here to share valuable insights to help elevate your trading.
I'm gonna make it really quickly.
We're gonna be going over understanding trend lines, what they are.
So these things are called Bollinger Bands. And when the market is overextended, the market will be hitting. I gotta reset my stuff because it's not letting me even see the settings.
And real-time market data, and even some advanced tips. Trend lines are the foundation of technical analysis. They represent the direction and speed of a specific instrument, and they ultimately help traders identify trends and possible reversals. So what types of trend lines do we have? We have 2 types of trend lines. We've got an upward trend line.
Okay, it looks like this.
Higher lows, indicating bullish.
And these are called Bollinger Bands, right? And so ultimately, the whole approach was that when the market gets into these areas, that it doesn't like to hang out here. It likes to come back to the middle, right? Doesn't like to be out here. Likes to come back to the middle. Doesn't like to be up here. Likes to come back to the middle. This is the middle. It's the 50 moving average. It likes to return back to that 50. And I remember, you know, I would actually trade this, and it was like a guess and check. Like this is a perfect example, right? So over here, you can see the market was in there, and then we would try to trade to there. You set your TP for prices in there, and then what would happen? I get stopped out, stop loss above there. Try it again. Or I wouldn't get stopped out, even worse, I'd be in drawdown, because sometimes they had you trade these strategies with no stop losses. So we're trying to trade down here, and you can see it doesn't make it and push it up, right? Back up in it, trying to trade down here. This time we got pretty close to take profit, but it didn't work. Right now we're in here. Finally, we try to trade down, and At the time, the 50 was in here, so we would have definitely hit it, right? And so you could see this is exactly what I was showing you. You would have these moments where you would lose, and then win, right? And as I was looking at this, right? As I was looking at this, I remember just being frustrated, and I said, well, instead of me trying to trade to the 50, what if I went the opposite way? And I started to look around, because it felt like if I'm losing the majority of the time doing one thing, if I just switched it, logically it felt like I would be able to make money the majority of the time, right? And that's where my thinking and my development changed from trying to trade to the 50 and then trying to trade away from the 50. Now, if we look at this, and I'll do first upward trend line. Point A, point B, point C, 3 touch points. But when trying to find the cleanest example to show you each from the simple first, and then you go into, all right, this is fine. So that means we need to work our way down. Nah, that one is not as fine as I was considering. It's weird looking at the Bollinger Bands again. All right, we'll do this one. It's weird looking at these things because it's totally a different flow of how I trade now. And so seeing them on here like this, with my new understanding of things, it's just funny. It's just different. It's different. I never look at charts like that, but we always looked at them like this. This is crazy. So I said, instead of me trying to trade to the 50, right? What if I tried to trade away from the 50? Okay. And so what I want to show you is this. Part of the job was to get in here and to come up here, get in here, come up here, get in here, come up here. And I said, what if I wasn't trying to do that? What if I said, I'm going to stop trying to catch the bottoms of everything, and I'm going to allow the market to go. If I can get something like this, trade away from the 50s, right? Now, that right there was a game changer. I'm going to show you over here. Instead of trying to trade here, right? What if when I got to the 50, I tried to trade from here, or I tried to trade from here, or tried to trade from here? Okay. Now I'm going to get rid of this Bollinger Band, and I want to talk about what that shift became. Instead of trying to catch the tops and the bottoms, which that approach did, what this did is, if I draw this, notice what's happening. We see that 1, 2, 3 that we was talking about, right? We see that 1, 2, 3 that I was talking about. And all of a sudden, I started to realize that actually the optimal place for me to be looking for my trades is not up here trying to catch the top, but letting it go first, right? And then letting it take a break, and me trying to participate in here. This for me became the optimal reversal approach, because this for me tended to be the optimal place. Now, why is that? Well, I now have to go back into a little bit of Elliott wave. I told you, and you guys wrote this down, that when impulse waves move, all right, they move in 5 waves. They move in 5 waves. Now, look at this. We have 1, 2, 3, 4, 5. Now, here's the thing about this. And again, you don't need to master Elliott waves, but you do need to have a basic understanding of some very important principles. And one of the most important principles to understand about an impulse wave is this. We have 5 waves here. And within these 5 waves, right? We have a 0 to 1 wave, right? That's our 1. We have a 1 to 2 wave, a 2 to 3. This is our 3 wave, a 3 to 4, 4 wave, and 4 to 5, our 5th wave. Now, this right here is an impulsive wave. This right here is a corrective wave. This right here is an impulsive wave. This right here is a corrective stage. And this right here finally is an impulsive wave. Okay. And so what's happening is we know this market is moving up, and all of the impulse waves tend to be taking us up. All of the corrective waves are taking us down. Okay. What's up, Ina in the building, Kwanzi in the house as well. What's up? Now, check this out. There is a basic rule here that says this, that when this impulse begins, that the correction, which happens here, which is our 2 wave, it can go as far as the bottom, right? And come right back to the starting place of this wave 1. But it cannot go lower, okay? So it's never going to do this, then do this, and then do that if this is an impulse, okay? It's a very powerful, important principle. It will never go back below, okay? So this right here never comes down here. It can go all the way down, right? But it never comes down there. Now, what about this? Well, when this happens, after that 3, the 4 will never do this. You're never going to see it come back here. You'll never see it come back here. And you won't even see it come in here. It has to stay above this point right here, right? It's never going to go below. You don't have to worry about it going below there, or going below here, or going below here. Okay, that's the cool thing about it. And then this can go here or go here, right? So this will never, ever, ever go into the territory of wave 1. Okay, and this will never, never, ever go below the initial wave from below the 0. Never retrace below that. Now, since this is true, if this is the starting point, right? This is the start, and this is the end. Okay, started here, ended here. Well, notice something about when we do this. When we do this, notice how we can go, but we are going to come back. And when we come back, we can come all the way down to here, but we'll never go below the 0. Now, what if instead of trying to catch this, we let this occur, and then we try to catch this? What is the advantage of this? This has the biggest advantage. Why? Because once this goes, we will never come back to here. And usually we'll stay far away from here, because wherever this ended, this will not come into here. So it doesn't pull back that far again. Look here. This will never be able to go into there. It just won't. So this right here, wherever we caught this, becomes like the perfect place for us to take a trade, because we can now get the fullest move. This is a more confirmed opportunity than trading over here. Why? Because trading over here, one, you have to figure out the perfect time to start this. But 2, this right here, it lets us take advantage of the wave without the drama of this, without the guessing and the checking, without the worrying and the stressing. Okay. And so this is where I begin to see, wait, there's an advantage to me actually understanding this approach and taking advantage of this. So I went from no longer trying to catch the beginning. I started to try to catch this continuation. So look in here. You can see here how when we went up, we went here. And when this happened here, we're pulled back. But guess what's never going to happen? We're not coming back into here. So we're not going to get stopped out. And we can't come any further than this point here. And we didn't. We can't come back to any of those places until there is a completion of the whole move. Okay. We have to complete the whole move. So this became the optimal reversal point right in here, because it gave us the best returns and had the most confirmations. It allowed us to take advantage of this market and not have to worry about much at all. Okay. This being the optimal reversal point. Now, in a three-wave scenario, which is a correction, they're going to be ultimately several different things that are going to occur. Okay. And unfortunately, the three-wave is not as crystal clear as the five-wave. But the cool thing about it is that you can still leverage the three-wave and have some fun, right? Now, the three-wave typically is going to look like this, but sometimes it's going to look like this. Right? Sometimes it's going to look like this. Sometimes it's going to look like this. It's got a couple, not even a couple, a lot of different variations. Okay? A lot of different variations. But ultimately, still that same boom, 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 or boom, 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 or boom, boom, right? It has, that wasn't really the best, that last drawing, but it has that same boom, boom, boom. So that first boom that I'm talking about, that first move, right? I love to see this, because what I can do with this is I can wait for that second move to occur. And this is going to give me all the information I want to know about what's going to happen next. So I would have this, then I would have this. And however this occurs is going to tell me what to do next. Now, in ORS, I call this, I describe this as the call. I describe this as the call. You have the impulse, you have the correction. This is the call. Okay. Now, I call this the call. I describe this as a call. I try to say I describe it as a call, because call this as a call is always funny when I say that. I describe this as the call. Now, the reason I do this is because I have I've been a church kid my whole life, right? And in church, we have music that has this whole call and response type of situation, right? We have music, we have sayings, and this really is deep in our history, right? This call and response type of scenario. This is not just in church, but outside of church, right? The slaves, as they are journeying into their freedom, are utilizing this technique, right? Understanding how to move, right? In church, someone might say, God is good. And then the response would be all the time, right? Someone might say all the time. The response will be, God is good, right? My grandma, she'd always say, Jesus on the main line. You'd have to say, tell him what you want, grandma, right? That's the response, right? This is how this works. You know how to move by what was said first. You know how to respond. The market is talking to us. The market is talking to us, and we can know how to move based upon what happened here. This is going to give us our response. And it doesn't matter if it's an impulse or a correction. Now, I told you the correction has a bunch of variations, right? But it doesn't mean that we have to accept every variation, right? We don't have to trade all of the setups on the chart. We can be very picky and find the ones that fit the scenarios that we want to see. Okay? Find the ones that fit the scenarios that we want to see. Okay? Now, this right here, what's up, Mark, in the building? This right here, I like to describe this first part here as somebody else's money. Okay? I like to describe this first impulse as somebody else's money. Because we're not interested in catching the top or the bottom as I described in this thing. We're interested, right, in catching the continuation of whatever is about to happen. We want to respond. We don't need to be a part of the call. The tops and bottoms belong to somebody else. It's somebody else's money. Okay? Kyle out of Ontario, good morning. Okay? Somebody else's money. Man, these mosquitoes ate me up in Miami. I'm over here on fire in a couple spots. They got me good. I want to show you that example again. This right here tells us the information we want to know, right? The market is going. We don't care about this. So what don't we typically pay attention to? I say typically. We're typically not paying attention to taking advantage of a W or a inverted head and shoulders, right? That's not usually our focus. Now, when it's down there though, right, that can give us some information. This being a head and shoulders, it can help us with this trade, but we're not trying to necessarily trade it. What we care about is what happens after that inverted head and shoulders, after that. So here's what happens after the this move here, right? We don't really care about this. What we care about is this. Okay? Care about this. This is our friend. Okay? And this gives us all the information we want to see. Okay? We want to see. Now, when the market takes this break here, let me bring back on my Bollinger Bands. This, now that you guys are seeing this, this right here is that first turnaround point. And yes, markets will be overextended when this turnaround happens. Okay? When this turnaround happens, markets will be overextended. That's where they start. They're not going to start from a place where they're not overextended. So is there value still in Bollinger Bands? Absolutely. Enough value for me to make my chart all messy again with these lines and my other moving averages and my, absolutely not. Right? Absolutely not. But I want you guys to see the principle of when markets are kind of done, they will be overextended, right? You'll see them overextended not only in this tool, other things that show overextension will happen too, like the RSI, right? RSI, you'll be able to see that we're coming up out of being low, right? Just like this. This is overextension. These are factors that show up prior to us being able to take advantage of our money, right? So could these be used as confluences for you? They could. They could. Absolutely could. Right? But again, I wouldn't put it all on the same chart, right? So if you ever wanted to like utilize like, oh, let me see, am I coming from an overextended place, right? You could, right? Create a template or something that's on the side, you know, like maybe this is my overextension template, right? So, you know, something like this and overextension. Okay. This could work, right? I'm gonna put an N in the front here. Overextension, right? You could do that and look and see, are we overextended when that first move happened, right? Because there is some value in it, right? I'm not trashing it. I'm saying I had to move away from it because it would impact me. Now, probably because I have my system and the extra knowledge that I have now these days, I could probably make another dope strategy utilizing this. But I don't need it on my chart. But I do want you guys to see here how this overextension is a part of how markets turn around, right? We can see right here, we had the overextension, but notice that we didn't come down yet, right? It really wasn't until we came into here. Now, how do I know the difference between, like I said, where the one starts and where, some of these other areas? Well, you can again see we were overextended here. When this pulled back here, right? Notice that it wasn't overextended. It was a part. It doesn't have those same characteristics. It's a pullback. It pulled into Bollinger Bands and went deep below the RSI, went kind of low, 35. But overextension is going to take you 20 and below or 30 and below. Overextension is going to take you 70 and above, right? Those are going to be those areas. And it looks like when this is severely overextended, it does this whole lighting up feature here, right? Those are going to be some moments. Let's see if there's any more. And I'm not going to spend too much time on that because it's not the main focus, but I do want you to see that a lot of times those waves begin those places. Okay, look here. Now this one's kind of cool, right? So we were overextended, right, down in here, and then we pushed up. Well, what did I tell you? I'm always looking for this type of behavior, right? Now, did this one go 1, 2, 3, 4, 5? No. Why? Because this was a correction, right? But it doesn't matter because I'm ignoring this, and all I want is this. If this goes and does all that, then fine. But I'm gonna get this as well, right? That's what I'm looking for. That's what I'm looking for. But yeah, this was corrective, which was kind of cool because it went the other way after that was over. Let's see what we got. Okay, right here. This is another example being overextended, right? So we're overextended. And notice how we went up, right? Notice how we came back. Okay. This is what we want. That's what we're looking for. So where are we looking to trade? Right here. But notice how that overextension is a powerful component to this. Because if you have that overextension first, then you push up, then you pull back. Here's our optimal reversal point. Okay. Take all of this off. And look, it's the same pattern that we're talking about, right? We're looking for the market to go first, pull back, and then go. Okay. That right there is our ORS, our optimal reversal, okay, principle, that this is where we want to go. Now, I might as well save the template. I did save it. I did. All right, cool. We'll just keep it right there for a second. Now, let me come back over to the ORS. Okay. And let's look at something here. This same place, right, that I'm calling the optimal reversal place, I want you guys to look in here and see, now that I'm on ORS side, right? I want you to see something. I want you to see that the reason we don't take this trade for the buy is not just me being picky. It's that our pillars wouldn't have agreed. Okay. Let's get these brushes off real quick. Our pillars wouldn't have agreed. In here, to buy, our pillars would have said, no, you can't buy right now. Why? Because the 4 is below the 20. Because the 20 is below the 50. Right? Because price is below the 20 and 50. Because of that, we don't have the trend direction. Trend direction? Nope, we don't have it. What about momentum? Trying to buy here? No, our board of directors would have said no. Why? Because we need to not be below the 0 line. We need to be above the 0 line. So this right here, momentum pillar, would have said no. And then finally, the strength pillar. With the strength pillar, we would have also had a disagreement here, because we have bearish strength. So here we wouldn't want to take advantage of this trade. Okay. Now, what about in here? Well, by the time we would be looking to enter, which would be about right here, what will we have? The 20 would be above the 50. Price would be above the 20 and 50. Our momentum is in agreement, and our vortex would be in agreement. Now, you might say, well, in here it kind of still was a little choppy and sure, right? But overall, it would be in agreement, especially if we go into here and use the settings that you would want to check for entry. So for entry, which would be this candle right here, right? Or this candle right here. You would want to make sure that you had agreement between all of your pillars. Now, the settings for entry is always that you must have on the vortex or ORS strength, you must have your base, in this case, base above the quote. So if I come in here and we take a look at this, come on guys. Oh, man.
All right, so we're going to start in the monthly time frame. So we're going to hit the M up here in the top left. And now when drawing my trend lines,
right, there we go.
The reason I go to the higher time frame is because I want an overall view.
At the time of both of these candles, notice how the 20 or the base currency, right, base being the blue, is above the quote being this white. Okay, we would have had agreement. Now, the reason why I changed it from 50 to 14 is just so you can see this scenario. Now, on this one, you wouldn't have been able to enter. But by the second candle, you would have been able to, even with this 50 setting, okay? So I just want you to be able to see that is the 14 is really the entry criteria. Now, someone would ask why the 50? Well, the 50 helps me with a trend. It helps me see places to enter. And typically you're getting nice momentum once this begins to open up and separate from each other, right? And you get these pullbacks that happen on the chart up there with the candles. And if they're happening while we have this separation like this, oh, this is great, right? We'll talk more about the bully zone later, right? Once you get out of the bully zone, which is this area right here, right? There's a lot of strength and momentum that is kicking in. So taking trades after those points as well, you can be good. Now, what I will say is the trade that happens here earliest in the cross, right? This right here is typically going to be the beginning of movement, okay? The beginning of movements. And so looking at things in here and trying to take trades from in here, this is early on can be beneficial as well. Right?
Take notes and learn from
trying to leverage that cross,
so you
right?
can grow your trading account.
Now, if we look at our momentum pillar, everything would have been in agreement with that wave structure there, right? And if we look at our trend direction again, we can see
the slow moving
now
average. And then
we have our principle that we want the 20 and to be above the 50. We want price to be above the 20 and the 50. And we also want what? Well, we want the 4 to go above the 20. And you can see in here how this 4 EMA went below the 20. This would not be the time to enter. What would be the time to enter? Once the 4 gets above the 20 again.
But this is
not happened up on this candle right here. Right, and that's actually where everything was in place. Okay.
For me, this is simple.
Right here, we're taking a chance entering in on this engulfing candle here because the 4 still wasn't above the 20. Okay, but once the 4 gets above the 20, now we have that confirmation. Everything is good at the same time.
Either intraday or swing.
So this is the optimal reversal position because now look at us. We're in right here.
And
with
I want to be able to
loss
identify chop
here,
or ranges. Also
we don't have to worry,
it's equally
right,
important
that the market's going to come and stop us out.
And I want to be able
we
to
can sit in the rest of the move if you choose so, right? You can sit in the rest of the move until the trend has completed itself. And sometimes that can be some of the most amazing trades ever.
Because let's face it,
right? Look at this, 1 to 16. Until the trend completes itself and it's ready to turn around. You don't have to worry about the market coming back to your stop.
So context is everything. I use moving averages.
Even here, when this completed itself, this correction still didn't get us, right? Now, there's no way that I allow this correction to happen, right, and me stay in the trade. But my point is this shows you just how strong this is, right?
I'll show you how to do
this right here can be really, really good. Now, when we come back on Thursday, we're going to talk about this wave structure a little bit more in detail, okay? We're going to talk about a couple more things, and really, I'm going to show you why ORS is so powerful. You might already see it. You might already have an idea, but these confirmations are powerful. You do not have to trade the different strategies like, oh, I want to use the CJ or the impetus or the you know, the qualified pullback or, you know, all the different approaches that I've already outlined and made with the system. You don't need to do it. You can take your strategy that you have right now, and if all you do is check in with the board of directors when entering the market, it will change and enhance your strategy. It's impossible not to. The reason is because these are key components to why the market is doing what it's doing, right? Someone say, oh, I didn't want to do ORS right now because I felt like I missed the move.
to define trends either.
I mean, the only move you might miss is if your move is to catch that initial push. But then I could show you how we could still catch it and confirm it by utilizing some of the things that we'll talk about next week. And you would be able to not miss the move and you have the confirmation. That's your thing, right? But for me, I'm not worried about that. I see the power in waiting for the call to show itself, right? From there, I know what to do. I know how to respond, all right? So we'll pick this up on Thursday. Tonight we have fundamentals. We're in a new series on fundamentals, and so I'll see you guys.